Hello and welcome to From Recovery to Reset, the impact of the pandemic on the global economy. I have an illustrious audience with me who will introduce themselves shortly, but during the course of the session, do please engage in social media using ACT at ACT Update or hashtag ACTAC20. Do also feel free to ask questions using the Q&A button at the bottom of your screen. We really welcome engagement in the session. We're going to be covering so many issues, as you can imagine, and do please get involved, and I'll try and run the questions as we run through the sessions. The idea of all of this is that we have a conversation about the key issues and that you are involved with that conversation as well. I hope you enjoy. Let's just take an overview first, because what's going on at the moment is extraordinary in every single way you can imagine. We've looked at the impact on trade. The World Trade Organization is forecasting that global trade will collapse between 13 and 32%, which is the spectrum. But we're looking at GDP, collapses in GDP around the world, a collapse in demand, and all of this obviously has profound impact on the global economy. And against the backdrop of whatever might be happening with COVID and howsoever we might pull out of the recession, there's a sustained extraordinary monetary policy that global economy is having to deal with, US-China trade spat. We're looking also obviously at the outcome of the US elections and the impact that that might have on the global economy. And finally, of course, in the UK's profound concern, Brexit. With me to discuss this are Nick Vidalis from the ECB, Tom Orlik from Bloomberg, and Angelika Badalai from Citi UK, and Curtis Dubé from the US Chamber of Commerce. Nick, if I could come to you first and ask, how relevant is it for us to define the shape of the economy as an L-shaped or a U-shape or a V-shape or a standard deviation shape? What do you think about all of that?
Okay, thanks very much, Rebecca. Good hello to everybody. Before answering this specific question, let me say a couple of things how we at ECB see the outlook for the euro area. So as you know, GDP in the euro area fell dramatically, 11.8 in the second quarter, and had already dropped by almost 4% in the first quarter. Now, of course, these declines were very much related to the strict lockdowns that had appeared around mid-March. However, a relaxation of these measures from May onwards, as well as behavioral changes in the response to the pandemic, probably have led to a big rebound, a strong rebound in activity in the third quarter of this year. And indeed, both soft and hard data suggest such a rebound, looking at the indicators lately, but looking at all the indicators as a whole. Now, this suggests a strong but incomplete recovery of GDP, which according to our projections will be about 3.5% in the third quarter. I'm talking about quarter-in-quarter terms. Okay, what happens then? We assume, and this is a key assumption of our projection, a partial success in the containment of the virus, with some resurgence over the coming quarters, which is something we already see, which means that we have to continue to have containment measures, but less than in the first wave. That's a key assumption that we make, until a medical solution appears in the middle of next year. This is also an assumption, of course. Now, these containment measures, elevated uncertainty, a weak labor market situation are expected to continue to adversely affect activity. But on the other side, we expect a gradual pickup in global activity and, very, very importantly, support from monetary, fiscal, and labor market policies, which maintain incomes and limit the scars of the crisis. Just coming now to your very specific question about the shape of the recovery, let me first say that I hear this question very often. And I think it's quite important is to be clear what we are referring to. Are we referring to Q-on-Q growth rates? Are we referring to the path of GDP itself? Are we referring to year-on-year growth rates or some other metric? Now, if you refer to the GDP level, and this is maybe the most relevant measure, the most relevant metric, all I can say is that we have a very deep drop in activity in the first half of the year that we know, and then we have an only very gradual and prolonged recovery. So according to our assessment, the level of GDP reaches its pre-crisis level only at the end of 22, and still at that time will be 3.5% below what would have been without the pandemic. So pretty, I would say, concerning numbers. Now, if you force me to put a sign there, what exactly letter or symbol you want, maybe I will go for a tick-shaped, yeah? But let me stress that this is uneven, uncertain, and incomplete recovery. And let me stress again that this is all based on assumptions because nobody knows exactly what is happening. We have this resurgence, as I said, but again, the timing and the strength of the resurgence, the emergence of the medical solution, the effectiveness of the medical solution, this is all very uncertain. Key thing, and let me stress again, is policies. Policies is key to mitigate long-term scars and ensure a recovery. I'll stop here.
If I could just come in, I think the interesting thing for me there is the fact that, you know, we're all being quite honest about this, aren't we? We're all saying we don't really know what's going to happen, and therefore the shape of the recovery is almost immaterial. Are there any economies you think that might come out better than others in Europe?
I think everybody knows very little. The only way to say something is to have alternative scenarios, which we also have. So we have a scenario where things are worse than the baseline, which I explained before. In a severe scenario, when the pandemic gets worse, the medical solution comes late or is ineffective, or have a mild scenario where things are getting better. So the infections go down, there is an early medical solution which is also successfully implemented, and therefore the scars are not so deep, and the recovery actually is stronger. I think given the degree of uncertainty, one has to say, okay, what is most likely of all these three scenarios? What we think most likely at the moment is what we call baseline, but at the same time, we have actually these two alternative scenarios in order to capture this uncertainty around our projections. I don't think anybody knows, and scenarios is the only way to see what else can happen.
So you heard it here first. Economists don't know everything, and we certainly aren't able to predict the path that we're all recovering, literally, given so much of this is dependent on finding a treatment or a cure for COVID-19. Angelika, if I could come to you, what about COVID in the UK? Is COVID or Brexit going to be the bigger thing, do you think?
Oh, well, that's an interesting one. Good morning, good afternoon, everyone, first of all. COVID is obviously having a massive impact on the UK economy, and of course the UK is not unique in that regard, as we've just heard from Nick with regard to the Eurozone. For one thing, I think, you know, it's pretty obvious that there is a positive correlation between the severity and the duration of some of the lockdown and social distancing measures and the economic impact. And the measures in the UK have been fairly intense and prolonged. And in fact, you know, even at the moment, you know, in the UK, there is a lot of discussion at the moment about the sort of resurgence of the virus and the second wave, and lots of speculation about possible reimposition of stricter measures. So that's one thing. For another thing, this is a crisis that is obviously hitting the service sector very hard, and the UK's economy is very heavily tilted towards services, even by the standards of advanced economies and you know, G7 economies, which in any case are services oriented. But you know, in the UK, services is fully 80% of GDP. And if you look at the sector that's called distribution, transport, hotels and restaurants, which is obviously the sector that's been most directly affected by the pandemic, that sector accounts for almost 30% of total UK employment. So it's a pretty significant contribution. Now, in terms of the outlook, I think a lot of the current projections, certainly the Bank of England's projections, they're pretty optimistic, but I think a lot of the official forecasts that have been done to date were done over the summer, and a lot of them, Nick was just talking about the importance of assumptions. So a lot of what you see that's currently being published was assuming no resurgence of the virus, and a gradual easing of the lockdown measures over the second half of 2020, and now, of course, that's not the case, and so those official projections might end up being revised anyway. For me, the key point is actually not really so much about the specific forecasts. I would really echo what Nick said about the uncertainty and how much we don't know when we don't have a good idea of how some of the basic drivers of the economy are going to play out. And by that, I'm not just referring to the way the public health situation evolves. More fundamentally, I think we still don't know whether this is going to be just, in inverted commas, sort of like an extreme version of an exogenous shock, in which case essentially you would see a sort of normal recovery, but what's unknown is the timing and the extent. So it could be that, or actually we still don't know, are we actually seeing, some kind of economic paradigm shift where you get a more fundamental restructuring of the economy? And the answer to that is really going to depend on factors that I think are actually outside the remit of economics. So it's things like, how much is social consumption, that's actually a phrase that the Bank of England has used, but how much is that going to be limited and constrained by people's, fears or new habits, even after the restrictions are eased. So, I mean, there are some factors that are supporting the idea of a robust recovery, like, obviously the rise in the savings rate and policies, very supportive monetary policy. There are actually also factors that are maybe going to prevent a strong recovery, like, the obvious ones are the rising debt levels and the prospect of much higher unemployment. I think it's too early still to tell which set of factors will hold greater sway in the end. But I guess what I will say is that I think in the UK, the economic disruption that we're seeing now, in a significant way, is sort of just an exacerbation of some of the structural economic issues that the UK has faced for a long time.
So if I could maybe come in there, you rightly said that the biggest issue was actually for the service sector, and we have seen in China that it's been, which was obviously the first to go into the COVID lockdowns and the first to come out as well. We have seen that the service sector has been particularly severely affected. But in the UK, there's obviously financial services that must affect financial services as well. And again, this morning we saw something about the scope for fraud and the scope for losses with the government support schemes. That's going to have a knock-on effect on banks, isn't it?
I mean, of course, the crisis and the situation has, it poses risks to the financial services sector, as it does to all sectors. I think in terms of, your conventional measures of economic activity, so, things like, strict economic output, GDP, I think a sector like financial services has been relatively less affected than some other factors. That's probably in part due to the fact that it's a sector where a lot of people have been able to work remotely. Obviously not all people, but a lot of staff have been able to work remotely relative to other industries, of course. And the sector has really been instrumental in implementing some of the the government schemes that have been put in place to mitigate the effects of the pandemic. So I think what I would say about financial services is that it's demonstrated a lot of resilience. I think it's adapted quite well to some pretty seismic shocks over the last 6 months. It has been affected, but probably less affected than some of the other service sectors, obvious ones like hospitality and retail, for example. And I guess what that means is that it probably leaves the sector in a good place to help really contribute to the recovery that we're going to need to see going forward, because at the end of the day, it is about financial intermediation, right? It's about facilitating economic growth in other sectors as well.
So again, that's very similar to around the policy side of all of this, and how policy can actually aid recovery, and how important the policy dimension is to all of this. But again, you're making the point very clearly that it's about uncertainty, isn't it? So do you subscribe to Andy Haldane's view that we're going to be a V-shaped recovery, or do you think he's modified his view since he made that statement back in the summer?
Well, I certainly wouldn't want to put words in Andy Haldane's mouth, and I know we will have a new economic outlook published by the Bank of England in early to mid-November. So I wouldn't want to preempt that. But yeah, I think in terms of the shape of the recovery, I would really strongly echo the point that Nick made, actually, which is that of course we will eventually see the bottom of this. There will be a recovery, whether it's V-shaped or square root shaped or tick shaped. But I think that the really important point is to put that in context. And yes, I fully agree that the key point is that yes, we'll have a recovery, but we are not going to see the economy return to pre-pandemic levels of output for quite a while longer. And I think that in lots of the discussion around rates of growth and the shape of the recovery, that quite important bit of context is something that's often lost.
So, I mean, you're talking about an environment of uncertainty, and this is obviously a huge issue. Maybe, Tom, if I could come to you, uncertainty. I mean, we're not just talking about COVID here, are we? We're talking about a much bigger strategic picture between China and the US, and COVID has become part of that. I mean, quite apart from the president becoming ill over the last week, he blames China for the virus in the first place. That's not going to help relations. That's not going to help economic certainty, is it? So I guess what I would say is, how is COVID affecting China's ambitions at the moment? How are we likely to see that relationship between China and the US pan out over the next few months, given the election, given all the uncertainty there?
Thanks, Rebecca. Great to be here. I'll come to the China question in a second. Before that, if I may, just a word on V's versus L's. I think the market has the idea of a kind of a V imprinted on its consciousness. It's very hard to sort of shake the fundamental assumption that V's are what happens. The historical experience, if you look at the pattern of recessions across the G7 for the last 20, 30, 40 years, is that you don't ever get a V. It's almost always some version of an L. Output rarely comes back to the pre-crisis trend. So this one, I'm sure, is going to be different. They're all different in one way or another. It's an exogenous shock. There aren't kind of imbalances that need to be worked through. So from that perspective, there's a better chance of a V. I would be very surprised if it was a perfect V. I think Nick's kind of tick-shaped conception probably gets it about right. So on China...
just come in on that for a second, because sure. I think that, I mean, it kind of, we said we wanted a discussion on this, and I'll just, before you come in on China, I think this absolutely encapsulates a problem, doesn't it? We're not necessarily going to see output recover, even if we see a sharp uptick in what's happening. We're not necessarily going to see economic growth recover to where it was before. Certainly my own modelling of trade suggests that it's not going to go back to pre-crisis levels, but some of that is because of what Angelika was talking about, which is actually the size of the shift, the structural shift in the global economy, isn't it? And obviously China's part of that.
Yeah, and the other thing I would say is, in an intense downturn, and we've just had a downturn of record-breaking intensity, things get broken. Small businesses go bankrupt. Workers lose their jobs, lose their skills, lose their connections to the labor market. And these are things which are just are not fixed quickly. So coming to the China question, I divide it into two parts. You have the COVID shock, and you have the relations with the United States. So on the COVID shock, China went into this first, but they also came out of it first. And in many respects, they have managed their outbreak more successfully than most other major economies. I'm sure many of you have seen the pictures of Chinese people traveling for the autumn festival, hundreds of millions of people going through the bus stations and the train stations and the airports. I mean, this is an economy which is, I wouldn't say it's back to normal, but it's much closer to normal than I think any other major economy. We think China will grow around 2% this year. Almost all other major economies are going to face a significant contraction. So on the COVID shock, I think China looks pretty robust. US relations, I think, are more troubling. Clearly, we've seen a deterioration in the last few months. We had a trade war in 2018, 2019. That felt really bad at the time. With the benefit of hindsight, it now looks like the good times, right? At least the US and China were having a kind of common discussion around how to get the commercial relationship onto a sustainable basis. Now we have technology sanctions, we have sanctions over human rights, we have consulates being closed. We have some really extreme language coming out of the U.S. State Department from Mike Pompeo, the U.S. Secretary of State. So relations are really very weak. Now, if it's just talk, right? If it's just talk and targeted sanctions, that's going to be negative for China, but not really the kind of thing you're going to see in the GDP data. The problem for China would be if a future US president, a second term Donald Trump or a first term Joe Biden got more strategic about it, especially if the US picked up the phone to Japan and the European Union and the UK and developed something which looked like a kind of a coherent strategy for blocking technology transfer and making life harder for China's exporters. If that happened, not our base case, but certainly a possibility given the trajectory of relations, then we'd start lowering our medium-term forecasts for Chinese growth because we'd be worried about exports and we'd be worried about the capacity to catch up to the world's technology leaders.
If I can maybe come in there, though, I think what's interesting about China at the moment is that, to some extent, you could actually see the technology war is playing into China's hands. So you could say, well, the US actually is a net exporter to China in, say, semiconductors, but while it's actually restricting or putting barriers to the amount of trade that it does, that's actually going to have an impact on the way in which China operates. So it's got its Made in China 2025. It's got this sort of dual circulation strategy now, which is internal growth versus external international growth, and it just forces it back onto itself again. So would you perhaps say that there's scope in that argument?
Yeah. So the question for the US is, does it make strategic sense to attempt to block China's access to the technologies of the future? Or in the end, would that just accelerate China's progress and be self-harming for the United States? And there's a story there from the recent past around satellite technology. The US decided that satellite technology was strategically important, and they said, we're not going to share it with the rest of the world. And as a consequence, the US satellite industry kind of gradually atrophied, and other countries got the lead and dominated the global market. So that's the kind of the risk if the US starts to sort of close up and look more inward. The bigger picture, though, is that for all of the enormous advances that China has made in technology in the last few decades, and they really have made absolutely enormous advances, China is still playing catch up on technology with the rest of the world. It's the US who has the patents and the know-how on how to fabricate semiconductors, for example. And so if the door is closed, if a kind of a silicon curtain comes down between China and the rest of the world, yes, there would be an incentive for China to accelerate their own innovation efforts. But the first and immediate and most important impact would be it becomes harder for China to catch up, because instead of being able to learn from foreign technologies, they would have to do more to innovate at home.
So a lot of that is actually about standardization, isn't it? And who sets the standard has the control. Curtis, maybe if I could come to you now and ask, is it China that's going to have the biggest impact on the US economy, or is it COVID? Or the outcome of the US election? I mean, what's your view on the US economy at the moment?
Well, yeah, so all those things matter. But right now, the main driver of our economy is the virus. As the virus goes, so too does the economy. And it's right. This is an exogenous shock, and it's something we haven't seen in a long time. When you look at the Great Recession from 2007 to 2009, that was endogenous. That was inside the economy, and it creates a lot more uncertainty when you have an event like that, because you don't know how you're going to get past it and how you're going to get back to growth. It takes time. We know in this case that once we get past the virus, the economy will be in much better condition. We just don't know how we're going to get past the virus. So we know how to do it. We just don't know when that will come. And so the virus is by far the biggest impact in the immediate future. The election certainly has an impact. I think I've been talking about it. So we've talked a lot about the K-shaped recovery here in the U.S. So whether when it first started, it was, are we going to have a V or an L or a U? And it's really kind of coalesced around this idea of a K, which is that there are portions of the economy that are doing really well. Those are at the top of the K, and those that are doing poorly, they're at the bottom of the K. And the ones that are doing poorly it's pretty straightforward: restaurants, bars, accommodations, tourism, airlines, anything where the business just cannot operate at full capacity or at all because of the virus. They're at the bottom of the K. And then those that, like the technology, retail sales here incredibly have been a V-shaped as well. So the economy I think is doing as well as it's going to do. I think we'll probably continue on the track we're on now, assuming we don't have a major second wave that brings on another lockdown. So I think we are where we're going to be. But in terms of the outlook, though, it's also a K-shaped or a bifurcated response. So I think markets have built in expectations of a Democratic sweep here in the U.S. in November. So that would be a Biden presidency, a Democratic Senate, and then continued control of the House of Representatives by the Democrats. They've priced that in to some degree. I don't think they've priced in the legislative agenda that could be coming. And I think that's because the real impact of that would be down the road. It wouldn't even be early 2021. It would be into late 2021 into 2022, because they want to do really big sweeping things. It takes time for that legislation to get passed, and it takes time for it to be implemented. So that's why I say the virus is what really drives things in the near term. On best case scenario, and I'm usually pretty optimistic on this, you're looking at a vaccine that maybe rolls out in early to mid 2021. By the time you get that distributed around the world, that's going to take some time. So we're talking about this time next year before you really can get to open up, and that's on the best case scenario. But even then, that's still the main driver of the economy, in addition to anything that is happening on the electoral and legislative front. Now, if you had a go ahead.
No, I was just going to interject quickly on that one point about a stimulus now. So Trump has said he's not going to look at any kind of stimulus until after the next election. He's come out with that in the last 24 hours. How does that affect the legislative and the sort of fiscal program that the next president, assuming it's Biden, might have?
Well, so the president says and tweets a lot of things. And so I don't know whether that actually holds right now. Who knows? the thing is that the time was getting short anyway. We're less than 4 weeks out now from the election, and the Senate is busy doing other things, and members of the House and the Senate are out campaigning. And it seemed like we had already hit this kind of weird stasis where both parties were happy to do nothing. So Democrats were happy to do nothing and blame it on the president and the Senate and Republicans. And Republicans were happy not to do anything because they weren't really comfortable spending $2 trillion on a stimulus package anyway. So we were kind of already there. And so the president tweets that out and kind of pulls the veil off. But I think so if you have a surprise and Trump somehow pulls it off again, then I think he probably wants to push for something. But who knows with him what he'll be thinking. And then with Biden, he's going to want to do a big package, right? They're going to run the Obama stimulus playbook back again, and that's what we'll be looking at starting. They'll start pushing that in a couple of weeks.
So, I mean, in a sense, Biden doesn't make that much of a difference, does it, in terms of the uncertainty around US-China relations? Because China is always a big thing, as Tom was talking about. China is always a big thing in US elections anyway, and Biden is still having very much to play with the same language and the same rhetoric that Trump is using, isn't he? Or do you think there'll be a shift in those types of relations after the election?
I think it would be a pretty big shift. Electorally, I don't think Biden's been all that rhetorically strong on against China, not to the degree that Trump is. And Biden would be I don't want to say a total complete sea change, but it's not going to be nearly as adversarial as Trump has been the last few years.
So,
Rebecca, could I briefly come in on that, Rebecca?
Yeah, please.
Okay, great. So I would just echo a couple of points that Curtis made. So I mean, I think the election in the US, in case anyone hasn't realized this, is extremely consequential, both for US domestic policy and for US-China relations. The absence of a fiscal stimulus in the US is an extremely significant factor. We think it's going to subtract 5 percentage points from fourth quarter GDP growth and subtract from growth into 2021. If we get continued gridlock in Congress after the election, that's going to stay as the base case. If we have a Democrat sweep, which is the most likely outcome, but by far from guaranteed, we probably get that stimulus which Curtis was mentioning, and that means that 2021 moves on to a stronger trajectory. And on US-China relations, I mean, it's clear that the view of the US voter on China has changed and it has darkened. So Trump wins, Biden wins. We're certainly not going back to the kind of friendly kind of chimerica embrace that we had under Obama and under Bush and under Clinton. But I think what's happened under Trump is that the diplomatic guardrails have come off, right? And so you've got this kind of extreme uncertainty in US-China policy. And I think what you'd see under Biden is, yes, China is still regarded as a kind of, in some respects, a strategic rival, but the diplomatic guardrails come back on. And so you have much more predictability, you have much more certainty in the relationship, and that's going to be important for businesses and for markets.
Yeah, and I think he's more likely to bring in the sort of rhetoric around globalization, multilateralism, and sort of friendliness with Europe. I'm going to come back to the issue of uncertainty in a minute, but I just want to remind anyone who's listening that you can ask questions. Do please ask questions. We welcome them at this stage. But while those questions are coming in, I'm going to exploit my position as chair and moderator by asking an absolute blinder, I suspect, which is how long are we likely to see, now that we're in our second wave of extraordinary monetary policy as well as our second wave of COVID, how likely are we, and I'm throwing this out to the whole panel, so do come in, how likely are we never to see the return to ordinary monetary policy? Is monetary policy dead, basically? So who dares wins? I know we're talking personally here rather than on behalf of our organisations. but obviously it has a consequence for the stability in the world and some of the certainty in the world. And Nick, I don't know whether you want to say something about monetary policy uncertainty, and you were talking very vocally about how important policy is at the moment.
Yeah, of course, I can say a few words. I mean, I think it's very clear, very well known what the ECB has been doing lately. I can very quickly explain the reasoning behind all this. So all the measures we have taken since March were meant to provide support to the economic recovery and safeguard the medium-term price stability. So to ease the stance, so to speak, the monetary policy stance. But that's one thing. The other thing, of course, which is very important and comes to your uncertainty question, is to avoid, minimize, reduce, whatever you want to call, negative tail risk, adverse tail risks, especially to avoid very adverse real financial feedback loops, which could be dramatic. And the third, of course, is to provide sufficient liquidity so things continue to run in a reasonable way. And we have actually a lot of things done in this in order to achieve that. Don't forget, we have negative interest rates, where the deposit facility is still at -0.5, where the TLTRO 3, which provides liquidity to those who want it. We have the big thing, of course, was the PEP, the Pandemic Emergency Purchase Program, with a huge envelope of 1,350 billion. That's vast, and there you can see that it has worked. It has actually played an important role to stabilize the markets. And also, as I mentioned, to ease the stance of monetary policy. Going back to the PEP, so together with the APP, which also was increased by 120 billion, a temporary envelope, on top of the 20 million monthly purchases. So we're talking about a lot of money. All this has definitely reduced the 10-year euro area sovereign yield, but also has impacted in specific yields in some euro area countries. So it has reduced fragmentation, let's say, which is also very important. And of course, the reduction in the yields, in the bond yields, is a factor that is key to support the economy. So we've done a lot, but of course we cannot be complacent. There is a lot of uncertainty. As we all agree, things are pretty open the way they can go. For us, you know very well that inflation is very low, much below than we would have liked. Also, our projection for 2022 still shows inflation at 1.3. So again, we've done a lot, but I need to say that we need to be open, see what else is needed. As many times, and this is something I'm repeating, what has been said several times, that the ECB stands ready to use all the tools that has at its disposal to ensure, that inflation eventually goes back to our objective, and the economy somehow continues to work in a reasonable way. But maybe very quickly say that it's not only monetary policy. We have also a lot of fiscal support. Yeah, we have national fiscal policies, and if you see, the size of this is 4.5% of euro area GDP, which is a lot. Don't forget also that we have also the automatic stabilizers, which are also there to support activity. And of course, as you know, lately we have the Next Generation EU, a big actually project that comes from the EU itself, of 750 billion, 5% of GDP, which is also meant to support the European economy. So there are so many things on the table. We have also the government guarantees, the loan guarantees, 20% of GDP. So there is a lot on the table. That's why I mentioned before that the policy support is important. Is a lot of policy support. There is a lot of policy support, and maybe the final point is that the policy support has to be there and not to be withdrawn prematurely before we assure that things are getting in the right way. So that's a quick overview from my side.
Yeah, no, I think it's really interesting because the point that you've raised there is this balance between fiscal and monetary policy and the two sides working together, which maybe they didn't do during the global financial crisis. Maybe COVID has done something very interesting on that, which has made policymakers realize that the fiscal and the monetary side of the economy, which all of us economists could have said years ago, need to work together. So, Curtis, maybe has the Fed laid down its red line there and said, right, well, we're not doing anything with interest rates for the next year at least, and therefore you've got your forward guidance there. It's certain we know what's going to happen, and therefore policymakers can do what they want with fiscal policy within that framework.
Right. Yeah. I think the minutes come out today, but I don't think they've changed their guidance, which was that they're not thinking about raising rates.
21, yeah.
Yeah. So the rates are going to be where they are for the foreseeable future. There's no doubt about that. I think what's interesting when you said, are we going to get back to normal monetary policy, is that there is no normal anymore. We departed from the textbook definition of what monetary policy is back in 2007. We were maybe starting to go back there a little bit, but not really. I mean, we had two kind of financial disruptions in the previous to the COVID shock in late 2018 and then September of 2019, because the Fed is still trying to figure out how to newly administer the way they do monetary policy. So they're working out the kinks, but they were starting to reduce the size of the balance sheet and try to go back to something more approximate to pre-financial crisis normal. But now it's never, whatever this new normal, whatever we call this is going to be the way going forward, because it just never got to the point where they could try to go back to what they used to do. And now this is going to be, what they're doing now is going to be with us for a while. And this is just, we're not going back. So the Fed is permanently shifted to whatever we're going to call this, directly administering rates rather than allowing for a market rate, having these enormous liquidity backstop during times of economic stress, and everything else that they're doing now. And I think it's probably a good step. I think the Fed is a lot more effective than it was prior to the financial crisis, but there's a lot more dangers that it's created as well. And in terms of inflation, they're really going to push hard to get back to 2%. We're still pretty well below that. So again, interest rates aren't going anywhere until we get on average a 2% inflation rate, and we're still below that. So there's some time for this low interest rate environment.
So I mean, that actually segues into a brilliant question that the audience have just raised, which I think is fascinating. So we're not going back to normal monetary policy or raising interest rates until we see some inflation coming in. As economists, we'd also say that the amount of fiscal stimulus, theoretically at least, ought to lead to higher inflation. We'd all say that's too much money sloshing around. And yes, apparently it isn't too much money sloshing around. So what happens to all of that debt? So, I mean, do we need to keep on incurring that debt? What type of approach to that debt do we need to have? Maybe Angelika, you'd like to come in on that?
Yeah, sure. I'll start actually just with adding my thoughts on the discussion about monetary policy. I mean, yeah, I totally agree that we haven't had anything remotely resembling quote unquote normal monetary policy for more than a decade now, right? And I think what's interesting is that, in the wake of the 2008-9 financial crisis, when central banks first adopted this, what was called unconventional monetary policy, there were all the discussion was indeed around inflation and, the risks of, significantly above target inflation. And I guess, what we've seen, we've kind of in a way gotten very used to it now over the last 10 plus years, is that in fact central banks can push a huge amount of money into the system. And because of other offsetting factors, I mean, there are too many to go into in the time that we have, but just the effect of globalized supply chains and other things. Central banks can push all of that money into the system and still see, very, very low inflation rates, or in some cases even deflation. But then, this point about what are the other risks or what are the other potential unintended consequences, I think is a very, very important one. So yes, conventional measures of inflation have been, CPI, RPI, they've been very low. But there's the elephant in the room, which we haven't talked about, which is things like asset price inflation, right? Certainly here in the UK, that has very big implications for policy. It has significant implications for things like the sort of income and wealth inequality debate that's going on in the UK. So again, like a huge, huge topic, which I'm sure we don't have the scope to cover here, but it is linked to the question of monetary policy, I think. In terms of fiscal policy, I mean, there was quite a bit of fiscal stimulus in the wake of the 2008-9 crisis as well. I think the big difference between now and then is that, in the wake of the financial crisis in 2009, there was actually quite a lot of active global coordination of policy. Now, I think globally there's less overt sort of active coordination, but actually I think it doesn't necessarily matter so much, because essentially what you've seen is the same effect, because most countries have had a coincidence of wants, right? Policy in almost all countries, even if it wasn't deliberately coordinated this way, all countries are essentially implementing policies to try to support demand by supporting the labor market and to preserve jobs, essentially. In the UK context, yes, I mean, record rates of borrowing and debt issuance. There's obviously no question that any moves towards fiscal consolidation that might have been happening have been temporarily abandoned, which I think is the right thing to do under the circumstances. I think it's pretty clear from gilt markets at the moment that that the debt can be absorbed. But at some point in the longer term, it's hard to say exactly when, but there will have to be some kind of correction. And I don't think it's hugely controversial if I say that at some point in the medium term, I think at least in the UK, we will be looking at tax rises.
Okay, so are there any silver linings for the UK? COVID, GDP, our GDP projection being worse than G7, and Brexit. Are we going to see some sunlit uplands at some point, do you think?
Well, I guess it depends how you define sunlit uplands. So I wouldn't put a phrase on it. But I mean, look, I think there's no doubt that at least if we look at 2021, it's going to be a challenging year. I mean, all of us in the UK and elsewhere are still going to be dealing with the effects of COVID. In the UK, there is, of course, additional policy uncertainty because the Brexit question and whether or not there'll be a deal after the transition period ends this year remains unresolved. And I guess what I would say is, again, to echo some of the comments from earlier in this discussion, policy is going to be absolutely critical. There's going to be no avoiding some of the, the difficult economic and business conditions in 2021. But I think, at least with good and consistent policy, hopefully we can mitigate some of those difficulties and then, hopefully look ahead to what will hopefully be a better 2022 and beyond.
Now we're beginning to come towards
Rebecca, could I come in briefly on the...
Yeah, sorry. I was going to ask you about debt, actually, and you may want to improvise around the theme, but I was going to ask you about emerging market debt, and because it's another question that's come in from the audience, and also corporate debt.
Sorry, I missed the last thing there, Rebecca.
So also corporate debt. I mean, we're seeing very high levels of corporate debt, and I'd just like you to answer that briefly, and then I'll ask everyone to think about whether or not economists are the right people to be dealing with all of this from a policy point of view. But if you could just answer on the debt question first.
Sure. Let me just offer one brief reflection on this broader question about monetary and fiscal policy. So this to me seems like a historic moment, right? So I think we need to go back to history to understand what the significance of it is.
Okay.
Feels to
So
me.
I'm sorry. Could you be very brief? I'm really sorry. I'm being told to wrap
Yeah,
up.
so it feels very similar to the period in World War II, when the job of central banks was essentially to provide financing for ministries of finance. And if we think about what happened after World War II, the process of unraveling that wasn't something that happened in 1 quarter or 2 quarters or 2 years. It was something that happened in decades, right? Central banks did not extricate themselves from fiscal dominance until decades after World War II ended. So I don't think this is a short process we're looking at. I think it's a very long process.
So I'm afraid I think I'm going to have to wrap everything up now without asking that question about economists. But it is an interesting one about where the responsibility for policy sits. And if we had longer in our pub, I think we would be very much more able, in our pub quiz here, we'd be able to have a much clearer answer to all of that. I think it's been a fascinating conversation. Thank you very much indeed. Do get involved on Twitter and on LinkedIn, and don't forget the virtual networking sessions at the ACT as well. Thank you very much for listening.